When a company acquires inventory, the initial accounting step is straightforward. Assets are recorded at their historical cost. This includes the price paid to acquire the goods, plus any freight, insurance, and handling fees required to bring them to a saleable condition. But physical goods exist in the real world, and the real world degrades assets. A warehouse full of electronics might suffer physical damage, face sudden technological obsolescence, or see a rapid drop in consumer demand. If a company leaves that degraded inventory locked at its original historical cost, the balance sheet stops reflecting economic reality. The asset column would report a value the company can no longer reasonably expect to collect, falsely overstating the company's health to investors. To prevent this, U.S. GAAP requires intervention. When the utility of an inventory item drops, the company must mathematically write down the asset's value below its original historical cost. GAAP treats historical cost as an initial measurement, requiring subsequent adjustments to ensure the balance sheet reflects the current economic value of the asset. The exact mathematical framework a company uses to execute that write-down depends on the cost flow assumption it chose at the start of operations. During periods of inflation, different cost flow methods, like FIFO and LIFO, push completely different costs to the balance sheet. First in, first out, or FIFO, assumes the oldest goods are sold first. This leaves the newest, highest, and most current costs sitting on the balance sheet as ending inventory. Last in, first out, or LIFO, does the opposite. It assumes the newest goods are sold first, leaving the oldest and potentially highly outdated historical costs locked on the balance sheet. Because LIFO and FIFO result in different ending inventory balances, GAAP mandates two distinctly different mathematical frameworks to test those balances for impairment. A company's initial assumption about how costs flow through its operations dictates the strictness of how those remaining assets are subsequently measured. The first valuation framework is called the lower of cost or net realizable value, commonly abbreviated as LCNRV. The LCNRV rule applies to inventory measured using any method other than LIFO or the retail method. Most notably, this covers companies using FIFO and average cost. This diagram outlines how net realizable value, or NRV, is calculated. Starting with the estimated base selling price, the company must subtract any reasonably predictable costs of completion, disposal, and transportation. The remaining figure is the NRV. The trigger for this framework occurs when the company compares its recorded historical cost to this calculated NRV. If the historical cost is higher, the company must immediately recognize a loss and write down the inventory to the lower NRV. LCNRV is a streamlined reality check. It forces companies to compare original costs directly against the actual net cash generated from a sale today. The second framework is the lower of cost or market, or LCM. This rule is exclusively required for entities using LIFO or the retail method. LIFO retains older historical costs. Comparing decades-old costs to today's prices isn't enough. GAAP requires checking current conditions to determine true utility. Under the LCM framework, the term market has a specific definition. Its default starting point is current replacement cost, what it would cost the company to purchase or reproduce that exact inventory item today. However, unchecked replacement costs fluctuate wildly, so regulators impose strict mathematical limitations to prevent earnings manipulation. This chart models GAAP's market boundaries. The ceiling is net realizable value, preventing asset overstatements and delayed loss recognition. The floor is NRV minus a normal profit margin, preventing aggressive write-downs that artificially inflate future profits. The LCM framework traps the raw replacement cost between a logical maximum and minimum value. This ensures reporting accuracy by limiting how far an asset's value can deviate from its actual selling potential. We can run a stress test of the LCM algorithm using 3 different inventory items to see exactly how these boundaries dictate financial reality. Item A's $53 replacement cost sits within boundaries. Its lower $50 historical cost requires no write-down. Item B's $55 cost drops below the $58 floor, forcing a write-down. Item C's $40 cost exceeds the $39 ceiling, also triggering a write-down. The LCM algorithm ensures that external market replacement costs remain consistent with GAAP's internal logic for asset valuation. Once either the LCNRV or LCM algorithm triggers a write-down, the math is over and the accounting begins. That loss must be immediately recorded. On the income statement, the loss from a routine inventory write-down is generally absorbed directly into the cost of goods sold line item. There is an exception for scale. If the write-down loss is highly material, it cannot be hidden inside cost of goods sold. Under strict U.S. GAAP rules, a reversal of a write-down recognized in the annual financial statements is strictly prohibited. Once inventory is written down below its original cost, that newly reduced amount becomes the permanent new cost basis for that asset. There is a narrow allowance for interim reporting. Write-downs can be deferred in quarterly statements if no annual loss is anticipated, or recovered if taken earlier in that very same year. But once the annual books close, the write-down is locked. Subsequent market price spikes cannot be used to return the asset's value to its original cost. U.S. GAAP's valuation frameworks are a one-way street. They are designed to protect the balance sheet from overstatement, prioritizing economic reality over corporate optimism.